Hey everyone, welcome to today's video. So if you would have invested roughly 75 rupees in Amazon back in 1997, that investment today would have become roughly 84 lakh rupees. You could have purchased a Ferrari, you could have purchased a villa in Goa, I don't know. But to cut the long story short, you could not have done anything because these are khayali returns, and very similar to like khayali pulao, you can't do anything with these imaginary returns. We as normal retail investors do not have the patience to hold these type of things. When things go up so dramatically, we will cut our positions whenever we make even 30-40% gain. But is there a systematic way to keep on investing our salary every month in sensible stocks so that it gives us good returns? Now, I'm not promising 100,000% return or 500,000% return or 1,000% return, something like that. I'm talking about investing in decent companies month-wise in a systematic manner. Can that be done? And can you benefit from it as a normal retail investor? So that is the conversation that we are going to have in 5 simple, easy to understand steps. And also along the video, I will share my list of 10 stocks that I will do SIPs or systematic investment plan in. Now, SIP simply means that if I'm getting a salary of, let's say, 50,000 rupees, I'm able to take out 10,000 rupees for investing. Then I will put this 10,000 rupees spread across these 10 stocks. So that is the list that I'm going to present. Now, an important disclaimer, this is not a push from my side to go and invest in these stocks. Please do your own due diligence. Please build your own investment strategy and please be responsible for your own money. So that is a simple message that I want to give out, but I will give a very honest discussion analysis as to what SIP based investing is, why you should be doing it, and present a list of stock along the way. And this will be a well diversified list of stock which comprises of both Indian and the US stocks. So let us get the discussion started and 5 simple points. So point number 1 is that what is SIP and what are the advantages and disadvantages of SIP based investing. So SIP in simple words means systematic investment plan. This is also called as dollar cost averaging or rupee cost averaging. Please don't go after the terminology. Please understand the concept behind it. The concept is fairly simple, that you and I are making some kind of salary or some kind of cash flow every month through our job, through our business, etc., etc. We get a certain amount of money that we want to invest in the stock market in a systematic manner without thinking too much every single month in the stock market. So can that be done? And that process is called a systematic investment plan. So let me take you to one of the key instruments in which SIP is done, and this is called as index-based SIP. So basically, if you are investing 10,000 rupees in index every month, that is called as investing in index or running an SIP in an index. So you will pick that 10,000 rupee 5th of every month or 10th of every month, and you will keep on putting it on this index. So your investment might look like these red dots, that you are investing over a long period of time, periodic investments every month. And in the long run, what will happen is that you will get averaging benefits, because you can see that Nifty goes up in the long term, S&P goes up in the long term. And if you are investing periodically, that period can be weekly also, that period can be monthly also, that period can be bi-monthly also. So if you invest in a periodic manner, what advantages are you going to derive? You will derive 3 key advantages. Number 1, you will get averaging benefits. So what is meant by averaging benefits? So let us pick an example. So for example, here, if you are investing in point A and you continue to invest in point B also, here if you are putting 10,000 rupees, you are buying fewer units. At point B, again you are putting 10,000 rupees, here you will be buying more units. So on an average, you get to purchase more when the markets are down and you get to purchase less when the markets are up. So this gives you averaging benefits and this reduces your risk in the stock market. The second key advantage of SIP or dollar cost averaging is that it creates a system of investment. You might have noticed around you that when markets are running up, everyone tries to chase the market. They invest only when the markets are going up. When markets fall, there is a lot of panic. People stop investing. People stop their SIP also. If you go and meet some uncles in park for morning walk, they will say that, you know what, I read some news that this is going to happen with this stock. So why don't we all invest our money in it? Then after reading news, people start making investment. So all these are bad methods. This is not a system of investment. This is a system of punting. Punting simply means that you're just going and gambling your money. So doing SIP based investment kills this punting. It builds a system for you. It takes the panic away from you. You don't get super excited when the markets are going up. You don't start panicking when the markets are going down. So in very easy to understand language, it kills the emotion in investing, and that is a very, very important skill to develop as an investor. Now comes the third key advantage, and this is one of the biggest mistake that investors make, which is trying to time the market. That I will invest the most when the market has fallen the most. I will invest the least when the market has reached reach the top. We can't do it, and half of us keep on waiting for the markets to correct or markets to go up. So SIP based investing kills this problem as well. Now let me very briefly touch upon the disadvantages of SIP based investing. So first and foremost, it is super boring. Why? Because there is no thrill. You are going and investing in the market every 5th of every month or 10th of every month in a systematic way. And yeah, you are not even following the market. So it might not be thrilling for you, and it is pretty boring. So this is the first key problem, that there is no thrill. And what will you talk about with uncles that you find in park? So that is the number one problem. Now the second key problem in terms of SIP based investing is that you actually do not end up timing the market at all. So you just forget about the market, and sometimes it might actually make sense to time the market. Now, what do I mean by that? Because this looks confusing. So let me pick an example and explain. So for example, here you can see a downward falling curve. Here you can see a downward falling curve. Here you can see a downward falling curve. So you should be investing more and more of your money during these downfalls. You can back test this all the way to 1930, and people who have invested in these downward falling curves are the ones who end up making a lot of money. It looks very scary when the markets are falling, and every day your portfolio is getting redder and redder by the day, and that is not a very appealing sign. But if you're a constant SIP based investor, then you might not increase your investment amount when the markets are falling, and this is a mistake that you should avoid. In fact, when the markets are falling, that is when you should be purchasing even more aggressively. Now again, a disclaimer that I'm not pushing you to go and invest in the market. Please do your own due diligence and please act as per your understanding. I'm just sharing my viewpoint. Now comes the third key problem in terms of dollar cost averaging or SIP based investing. It is that you end up purchasing the entire index. So for example, if you're doing SIP in Nifty 50, and if some bad stocks, bad I mean according to your definition of bad, if they are part of Nifty 50, then you inadvertently, so the word of the day today is inadvertently. I have covered it earlier also. So do let me know the meaning of the word inadvertently. So inadvertently, you end up investing money in bad stocks, the stocks that you consider to be bad. So for example, let me pick my definition of a bad stock according to me, and this is not a push that this is a bad stock, good stock. You do your own due diligence. I am just picking this as an example. So according to me, something like Bharti Airtel is not a good stock, but it is a part of Nifty 50. So you can check this on the list also, that it is a part of Nifty 50. Now, why am I saying that something like Bharti Airtel is not a good stock? Because if I go check its price, you will see 2-3 key things. So one, you will see that Bharti Airtel for a period of almost 10 years gave an average return of 0%, right? So it is a highly cyclical stock, so to say. So this is point one. Point two, systematically, if we study the fundamentals of Bharti Airtel, what you will figure out is that this is a high debt company. So let me show that to you through ratios also. So you can check debt to equity ratio, and its debt is crazy, right? It is very, very high levels of debt. And this can be checked on the balance sheet also, that its borrowing keeps on going up and up and up. Finally, let us take a look at the growth of the company. So if you take a look at sales or the total sales 10 years ago, they have not even been able to double their sales in a period of roughly 10-11 years. So which is not a great sign for me. So I would refrain from investing in such stocks. But the problem with SIP based Nifty or Sensex investing, where you are trying to buy the index, you have to by default get invested in these companies, which I as an investor would want to avoid. So according to me, these are some of the advantages and disadvantages of SIP based index investing. So now comes the natural question that is there a way for me to avoid this index investing problem? Because I also don't want to get invested in something like Bharti Airtel and similar kind of stocks. Okay. So typically speaking, you have two options. So number one is that you do index investing. For example, if you are investing in Indian index, then you have to by default buy something like Nifty 50 or Sensex. If you are picking US, then you have to buy something like S&P 500 or Vanguard fund from a global investing perspective. So this is called as index investing, and I have already discussed the advantages and disadvantages of it. Now comes the second method, that you can create your own list of stocks, and you can do this in India also, and you can do this in the US also. For example, the knowledge partner on this video is Vested. So they have come up with a Vest where I have created my own briefcase of US stocks, and you can go and check it in the description box. And if it looks okay okay to you, then you can create a similar vest for yourself. This is absolutely free of cost. There is no charges in terms of creating your own vest. So from that particular perspective, you can create a vest on Vested that can take care of US stock investing, and similarly you can create a vest for Indian stocks also, and you can start investing in it. So your goal every month becomes to invest some amount of money in your US stocks and some amount of money in your Indian stocks. Now again, not a push from my side. If you're not a believer in US stock investing, please do not invest. Please only invest in Indian stocks. Similarly, if you're not a believer in Indian stock investing, please do not invest in Indian stocks. Just invest in US stocks. I am just suggesting all the options because I myself invest both in Indian and the US stocks. So now comes point 3 and 4. These are very important points, that what type of vest or what type of briefcase you should be designing of stocks that you want to do your SIP in. Okay, so let us speak about what type of stocks to add if you're a complete beginner. So first and foremost, pick simple stocks. What are simple stocks? Simple stocks means that are generating increasing revenues with every single year or almost every single year. Plus there are profits that can be seen on their balance sheet. For example, if I show you the chart for Hindustan Unilever, you can clearly see that the sales have been going up. There has been no problem. Second, you can see that net profits have been going up. There is no problem. So it is very easy to identify these type of stocks. Remember another point, that please do not invest in very high debt oriented companies because you will have to constantly monitor these. So go take a look at debt to equity ratio. Here it is only 2%. For Airtel, it was close to 250% debt. So very easy to identify simple clean stocks. So these are the type of stocks in which you should be doing SIP based investment. This is point 1. Now comes the second key point, that whatever stocks you are adding in that vest or that briefcase, it should look like a portfolio. For example, if you pick Infosys also, if you pick TCS also, if you pick Wipro also, and you buy 10 such similar stocks, then that is not a portfolio. You have ended up putting all your money in just literally one sector. So it doesn't look like a portfolio. So please have a split of different things. For example, you can have some pharma stocks, you can have some FMCG stocks, you can have some banking stocks, you can have some tech stocks. So create a well-designed diversified portfolio. Now I will also show you how I will invest 1 lakh rupee in the 10 stocks that I'm talking about, given all these 3 points that I'm currently speaking. Now comes the third point, that whichever stocks you are adding to your portfolio, it should align with your investing style. Now what is meant by investing style? Now there are different types of investors. For example, there are very aggressive investors which will only invest in very high growth assets. For example, Mr. Vijay Kedia, he tries to invest a company very early, invests a lot of money, and he's okay losing money on 8 of his investments out of 10 because the 2 investments that will survive, it will give him massive gains. Very similar to the Amazon story that I was telling you at the start. So these are called as high risk investors. Do you want to become like them? I can't suggest. If that is what you want, then you can definitely create a slightly more aggressive portfolio. On the flip side, you can become a slightly more defensive investor, that we will invest only in HUL and ITC type of companies. That's it. We don't want to lose a lot of money because equities are very risky. So you are also not incorrect there. So you need to figure out what type of investor you want to become. Now you'll say that, Akshat, this is getting like very complicated. Can you explain it by using a real world example? Yes. So I will create a portfolio of 1 lakh rupee in front of you using the list of 10 stocks that I will be doing SIP in from this month onward. But before that, let us complete point number 4, that what type of stocks you should not be adding into this portfolio. So the answer there will be complete opposite to what I said as to what type of stocks you should be adding. But let us quickly go through that list as well. So 3 simple points, that number 1, please avoid high debt companies. For example, Airtel. Does it mean that you should never purchase high debt companies? I'm not saying it. But what I'm categorically trying to say is that if you're doing SIP in stocks where you're just putting money month after month, please avoid high debt companies. This is one. Number 2, please don't invest in companies where you don't understand how they are making money. A classic case in point, according to me, will be something like Paytm. I don't understand how Paytm is making money anymore. So I have not put even 1 rupee in Paytm. And that is the same viewpoint that I have been expressing since the time, even before Paytm's IPO launch. So you can go and check it out on my previous videos. Third and finally, please do not invest in only one dimensional or one type of stocks. Again, the IT example that TCS also, Wipro also, Infosys also, and all stocks, all IT. No, please don't do it, because what happens in the market is that there is something called a sector rotation. There are times when certain sector will be pumped up. So the entire IT sector will go up. Then it will be pumped down. So if you end up getting caught on the wrong side of the equation, you might end up losing a lot of money. So please hedge your portfolio. Please do not make your portfolio one-dimensional. Now comes the fifth and final point as to how will I invest 1 lakh rupees in an SIP mode across 10 stocks that I'm picking. So here is a list of 10 stocks. Why have I added these 10 stocks? You can watch some of my previous videos on Amazon, Microsoft, Hindustan Unilever. I recently made a video, why did I purchase something like HDFC Bank, Axis Bank, ICICI. I also talked about the fact, why am I adding something like Bajaj Finance? So you can figure out my rationale of adding all these stocks through my previous videos. So please go and watch those, and I will link some of those videos in the description box also. But now let me show you how will I be investing 1 lakh rupees. I will say, Akshat, 1 lakh rupees is too much. How will I get access to 1 lakh rupee every month? So please adjust the amount. Don't make it 1 lakh. Make it a fraction. So if you can invest 10,000 rupees, that is also fine. You can follow the same methodology. So if I have 1 lakh rupees to invest every month, then I will invest roughly 30 to 40% of my money in tech companies in the US, because I do not buy Indian tech companies. TCS is the first tech stock that I'm buying as of now in India. But other than that, I'm buying all my tech stocks outside India. So 30 to 40% of that money will go where? To companies like Amazon, Apple, Microsoft, especially now because these companies from their top have corrected by even 40%. So I'll be aggressively doing SIP as of now, given the market dynamics here. Second key category of stocks that I will purchase, it will be financial companies in India. So I buy finance stocks only in India. So here I will invest roughly 40%. So my money will go to companies like HDFC Bank, ICICI, Axis, and HDFC AMC also. I know I'll get a lot of heat, but yeah. So these type of companies I'll be purchasing every month. Now remainder of my portfolio, which is between like 20 to 30%, will be slightly more defensive. So this would comprise of companies like Dabur, Nestle, HUL, etc. So these are some of the key companies that I will be purchasing. Now my portfolio size is big. I will not get into speculation. Some will say that, Akshat, we saw your portfolio. No, that was not my portfolio. That was just last year's portfolio, so to say. I have multiple Demat accounts as of now, and I segregate my year-wise investing into different Demat accounts. I'll make a separate video on that. But to cut the long story short, this is what my portfolio will look like. That 40% finance, roughly 30 to 40% tech, and roughly 20 to 30% defensive. So you can let me know whichever stocks you are not clear on. I'll make specific dedicated videos on that. So do let me know in the comment box if there are detailed videos you would want to make. Why am I adding these stocks? I'll be happy to do it. Now, before I let you go, let me encapsulate a few key points regarding this style of investing. Point number one, if you are investing, let's say 10,000 rupees as SIP, there are some stocks, for example, let's say Bajaj Finance cost 4,000 rupees as of now. So you would not be able to buy Bajaj Finance type of stock every month. So what you should be doing? You should be buying it every alternate month. So that is how you should adjust as per the quantum of money that you're investing. This is point one. Point two, when the markets are moving up, there will be stocks in your list or in your vest that will be moving further higher than the market. So be more conservative in investing in those stocks as per the market dynamics. So please track the market dynamics. This is not buy and forget type of a strategy. Similarly, if the markets have corrected quite a lot, then increase your SIP amount. Try to invest even more money that month if possible. Third and finally, please make notes about the market. There are market changing circumstances. You have to stay on top of things. Investing is an active game. It is not a passive game that, you have invested, buy and forget. It will become like an Amazon-like story for you. No, it doesn't work that way. Let me reveal the answer as to why. Retail investors usually do not make 120,000% gains on stocks like Amazon, very simply because once the stock moves up by 40, 50, 60%, we do not have the patience to hold it. And I'm not saying that you should have the patience to do it, because no one would have that Zen level of patience. But the important point is that every month you should identify good opportunities to invest and invest in a systematic way, because every month you do get opportunities to invest. So please do not forget it. Please create a system. Please understand your investing appetite and investing risk and try to identify the type of investor you are. I hope you enjoyed the video. Please press the like button, share it with your friends, and I will see you soon.